My question was, I usually struggle with the whole idea of, revenge trading. You take one trade, you take a loss, and then you can't take the loss, and then you go and do it again, and then you take another loss. So the whole psychology idea is what I wanted to cope with.
Well, there's a lot of content about that, right? So, but it'll be interesting to get Michael's fresh take on that right now.
If I understand you correctly, you're asking how you can overcome the tendency to want to revenge trade and get back a loss or square yourself immediately once you have done damage to your equity. Is that what you're asking, or is it something more specific to that?
Yes, sir. Yes, sir. That's exactly what I'm asking.
Well, number one, do you journal?
Yes, I do journal. Yes, every day.
Okay, can you give me a kind of like a broad brush overview of what it is that you actually specifically journal and what are you targeting in your journal entries?
All right. So in my journal, so first thing I start with whether my bias will be bullish or bearish for the day, and I mark out the PDRAs that I'm gonna use to take a trade on, and then what I would be interested to see price do. And lately, maybe if I get a TP, I will, you know, write down the risk rewards and stuff. So something to that effect.
Do you have a well organized and written trading plan? Like, what's your model? Is it something that
Uh
constantly changes? Is it something that you're always tinkering with?
Actually, yeah, I kind of got confused because I started with the 2024 model, and then I watched all the 2026 videos. I trade Usually I trade the first presentation, opening range gap, and liquidity sweep, and I use the first presentation as a way of, taking a trade. That's usually what I do.
Okay, it sounded, and I may be misreading you, and I'm trying to be very careful. I don't want to make you feel like I'm coming at you. So we're just having a conversation, okay? But I want the folks that are also listening to this to think about themselves and how they may be in the same situation or have encountered it in the past, or you will probably do it in the future. I think that if I were to be blunt and go right to the heart of the matter, out of teaching lots of students and having lots of engagements with students all around the world and varying different models that they've used with my concepts, that the common denominator is they do not have a fixed model that they're leaning on as a go-to. It's a bread and butter type. Every day, I'm only looking for this for right now. And because I'm someone that kind of like wants to serve everyone, I have a entire buffet table of things you can choose from to kind of like fit your personal personality and trading style. But that's a lot to take on when you're brand new and you're not really experienced. So I simply say this because I think what you're trying to do is, as you watch price action and you see something there, it may be outside of your model. It may be outside of the specs that you have first sat down with and said, okay, today I'm going to try to go long or I'm going to go short. And I'm going to target this thing here. But then price action does its little charming little routine and it hypnotizes us and makes us fall in love with whatever price action wiggle and waggle it creates at the moment while you're watching it. And you think, well, maybe I was interpreting that wrong. And maybe I'm going to try that thing Michael was talking about where it looks like it's an inversion fair value gap. And maybe you've never traded inversion fair value gaps, but you just want to try it today. And then you hurt yourself. And right away you feel regret. And I'm not saying you do this, but just bear with me. Let me kind of like put down some tent posts here. The idea of taking on something that you don't really have as a model, that you haven't really done back testing on, that you haven't had any data, no no real history with it. Okay, think about it this way: if you owned a business and you hired 20 employees, and each one of these employees had their own individual responsibility, they have a task. Okay, maybe two or three of them are in a specific department, but they don't all do the same thing. They have certain primary functions that they fulfill. Would it be reasonable for everyone to come in and just decide to change their role in your business and just do somebody else's job because they just felt like it would be better for them to do it? Would you permit that to happen in your company?
No, definitely not.
Right. And what happens is when we start these trading businesses, if we don't have a well-written business plan, which is our trading model, and have history working with the numbers, doing you know research and development, making sure that we have something that's going to be profitable, we would never invest more money or hire employees to do jobs that won't yield them a paycheck. So when you're looking at price action, and when we as traders are inexperienced, many times we try to take on the task or job of another trader's setup when you're not skilled or trained or prepared to do their job. So it's best for you to try to stay inside of a very small circle in the beginning and use that small circle of influence where you only engage with what this model calls for. And if you can operate in that very small circle of inference to what price is doing, you end up developing patience. You master yourself, which is the most important thing. And you can't master yourself unless you have a model or a criteria that you adhere to. And it feels very confining and restricting in the beginning. And it feels like you're missing opportunities. And you're not. You're actually developing a skill set that helps you refine your attention down to very specific criteria. And if that criteria is not well written, if it's not written out in a plan that's easily understood, there isn't a lot of moving parts, you're going to go off course and try to do another trader's job. And if you're trying to trade another trader's model and you've never done anything with it before, you shouldn't be surprised when adverse results come to your hands. So what you have to first do is adhere to a single model. Now let's jump ahead and let's assume that that's what you're doing. Okay, I'm taking a great deal of liberty in assuming that maybe you are, but in case you aren't, okay, but I gave you that part already. Now let's jump ahead and say that you do have a model. You know what you're looking for in terms of a setup. In other words, what constitutes the trade going higher or lower? What draw on liquidity are you going to use from a reference? Is it going to be session highs and lows? Is it going to be a new week opening gap, high or low? Is it going to be a new day opening gap? Is it going to be the opening range? You're going to trade the first fair value gap that forms there, and you're going to look for relative equal highs or relative equal lows. And then once you get that, you're done. You're not going to try to do anything more in the day. You're not trying to trade the PM session. You're not trying to do the whole entire daily range. You're just going in there, you're getting your bite-sized cookie cutter approach to get your pound of flesh for the day and then walk out. Assuming that's the case, when you do this, if you suffer a loss, your rules, your well-written model should tell you that, okay, I took a loss. Was it a full maximum loss for the day? Now, when I say that, that's not the same thing as these prop firms where you can lose $6,500 or whatever it is. You know, that's pretend. That's monopoly money. When we're talking about a full loss, if you take a full 1% loss, you need to stop. So if you're taking trades where you're affording yourself the luxury, it seems like, but it's the horror show. Once you get that full 1% at risk and it takes it from you, you think to yourself, well, I can probably go in and get that back because I did something silly. You know, I knew I should have waited for this because hindsight's 2020. You see a little bit more price action, a little bit more candles are giving you a better depiction of what you didn't see at the time. And you maybe you do have a model, but you got overzealous because maybe I posted something, maybe I shared my opinion about something, someone else said something, or you just watched price action just spin off and start running, and you think you're going to miss the move. Missing the move or feeling inspired to get the trade back as a loss and back in the win column and get back to even, those two things many times are spurred on because of a lack of focus, not adhering to the model, not adhering to the rules. And if you take a full loss, whatever your full maximum risk is per day, if it's a 2% drawdown, if you hit that, you have to stop. You got to go do something else. I think 1% is fair. I think it's reasonable. And if you're brand new, a 0.5%. And I know in the beginning that doesn't feel like that anybody should be aspiring to do that. But you can see right away, we're having lots of parameters, lots of boundaries, lots of lines you can't cross. You got to stay inside this small little circle. Who's going to hold you as a trader accountable? Just you. Just you. And the only response to you doing the wrong things is the market correcting you. Now, if you're doing things out of spec, if you're doing things that are just generally wrong and you're offside and you don't have the right idea where the market's going to go, you have to let the market tell you. And how's it going to communicate that? It only communicates that with losses. So if you're going to have that dialogue with the marketplace and you're going to allow it to communicate to you, why would you give it a bazooka or a tank and stand in front of it and say, listen, when I make a mistake, blow me to smithereens, just completely wipe the floor with me, turn me into a pink mist, or give me a paper cut so that way I can realize I didn't do something I should have done, or I didn't see something, so it wasn't that harmful to me. I lived to fight another day. Or if you're risking a 0.5% and your maximum drawdown for one day is 1%, guess what that affords you? You can take another shot because you haven't taken a full stop in terms of your risk that's allocated for one day. But when we go into trading and we're first now introduced to the idea of potentially making money, we like to flirt with the idea that, well, I'll see what happens. I'll do 2% risk because it's my first time out. And if it wins, I could probably do very well. And that's going to encourage me. And you want to stay away from those types of things, because that's like going to the bar with your friends while you're married and you put your ring in your pocket and say, well, I just want to see if I can get any girls to find me attractive. I won't really do anything with them. But then when that really pretty one comes up, now you're put in a situation where, are you going to be strong enough to say no? Are you going to be able to live that life as that husband and stay inside those boundaries? So don't give yourself that enticement. Don't allow yourself to do that. And it's very hard to do these things as a trader because you're the only one in control. But the only punisher is the market. So you have to allow it to communicate to you that you're wrong, but don't give it so much power and control over you that when it does correct you, it's trying to destroy you, because it's indifferent to how much leverage you have. It doesn't know how much risk you have on. You are in control of that. But many times when we're in a drawdown, we like to personify that the market somehow chose you today to teach humility because you haven't learned it yet. So now it just singled you out today and said, now I'm going to teach this guy or this gal, you need to learn this today, and I'm going to destroy you. I'm going to run you out, and you're going to have to reset or refund your account. And all these things are constantly going through our mind because the discomfort of no control. We don't have control of where these markets are going to go up or down. We don't know if it's going to go to our target. And by submitting to these things in the beginning, if you don't have a well-rounded written model, you're left to your own emotions and psychology and concern about every single fluctuation in price action. And the only way that you can compensate for that is by having a long history of back testing, looking at how that model you're implementing worked in the past, and then forward test it with tape reading, then demoing it. And the more work you do in that, it takes all the uncertainty and the fear and replaces it with, am I sticking to the model? Am I sticking to the rules? Is the candlestick supporting everything I set up for a reason to be in the trade? If you're focusing on those things, you cannot, it's impossible for you to be worrying about the outcome of the trade because your attention's focused on what is every individual candlestick telling me. It's giving you feedback. And if you think about it that way, if you're long, a down closed candle or a bearish candle that's forming, you're going to see those form. But your attention is it coming down to a discount array? Is it respecting that? Are the bodies staying in the upper half when bullish? Is it doing these things I like to see in price action that considers us on side or order flow being still bullish? If you're doing these things, you won't be led by your emotions. You're not going to be tugged by the heartstrings and say, I wish I would have done more. I wish I wouldn't have put this trade on. You won't have all these things. And you allow the market to show you you're wrong. Let the stop loss do its job. And then after the transaction completes, do you still have enough to take another trade for the day? If you don't, or if you are extremely keyed up emotionally, force yourself, remind yourself that it does not have to come back into your account today. It's a loan. That's all it is. You're giving the market a loan that you're going to collect with interest. You're just not demanding that interest be paid today.
Wow. Buar?
Thank you so much, sir. I completely understood. That was great. I'm gonna stick to that actually.
Very good. I'm glad I was helpful to you.
Thank you. That was very helpful actually. Because if I'm gonna be honest, I've been struggling a lot because I did the same thing with my model. I tape read for about 4 to 6 weeks, and then I went on a demo trading, paper trading for about 6 more weeks. So around 12 weeks or more, I started I just got a funded account, and it's kind of new, and I'm not kind of familiar with the whole idea of having your own capital, let's say, to trade with, and it's kind of fearful at the first time doing it.
That's understandable, but there's no way around it. Like if you're choosing this career path in entrepreneurship as a trader, you have to embrace that uncertainty, but you have to disarm the marketplace. You have to disarm it. And the only way you can do that is by sound money management and risk management, not over leveraging, not making yourself available for more damage. And also, when it corrects you, if you have, look at it this way, the market is the parent, and you're forced to be subordinate to it. You can't master it. It'll never be mastered by you. I never master market. Nobody else has mastered the market. It's the position of authority over top of us, like a parent, and we are subordinate to it. And if we are subordinate to it and it corrects us, what type of response is this authority going to have on us when we stand in front of it and say, I'm not going to listen. I'm going to do more of what I just did, and I'm not going to take that as corrective instruction or deterrent. And I'm going to do more of the same and be extreme about it. What type of response would you reasonably expect to see? More losses, right?
Absolutely.
Yeah, definitely. Yeah.
So when we are being corrected, we have to be subordinate to, okay, I'm seeing something, my present understanding or my read on the marketplace, and this is something that men simply can't get it in their head. There's nothing wrong with saying, I read that wrong. I read that wrong. And I saw something there that I acted on. It looked like it was in my model. I executed on it. Things changed. Maybe you saw it you breaking down while you were still in the trade, and you could have collapsed it, but you didn't. But it's okay. These things are going to be a progress. It's something you're going to pick up over time. And you can't know it right from the beginning. Nobody knows it from the beginning. But you have to disarm the market so that way it can't hurt you to such a degree where it removes your participation or it messes with your psyche. If you start worrying about everything that you do in terms of taking a trade or missing moves, like I don't miss a move, I think, oh no, oh, goodness, I wish I would have taken that. I'm never going to be able to find another trade like that again. I mean, good grief. That doesn't happen. And everybody out there that has a model that works well, that holds up over time, they don't miss moves either. They don't go to bed and cry themselves to sleep because they missed the Bitcoin rally, or they missed this, that, and the other thing, or they missed the silver rally, or they missed the silver collapse. They don't think that way. New traders or people that don't have a model or action hounds, gamblers, basically, they always talk in terms of regret. And you have to guard yourself and make sure you don't record things like that in your journal. And you got to make sure that you don't think that way or speak that way while you're in front of the charts. And it's real easy to do. You don't realize you're doing it until you catch yourself. And if you're not listening for it or paying attention to it, you'll actually talk yourself into this victimhood. And victimhood tends to spawn this gambler type mentality. And we don't like feeling like we did something wrong. We don't like it. Just like a child doesn't like to be scolded by their parent. They don't want to cry because they're frustrated. They want to be able to say, no, I don't want to do what you told me to do. And when we do that in tantrums in the marketplace, in our trading, it's very expensive. And then we blame many times externally things that had nothing to do with why we did it. And we constantly feed ourselves this loser's loop cycle that constantly goes over and over and over again. You keep doing the wrong things and thinking the wrong way about it all. When it all goes back to us as the trader, we have to be in control of ourselves. We're not in control of the market. We have to submit to that uncertainty. We have to embrace that. But we have to give the market the opportunity to communicate to us that we're right or wrong. But when we're wrong, don't give it the tools and the weapons to remove us entirely or do so much damage that we can't follow that model anymore, because the model's proven itself. It's there. But you as the operator, you may have done something incorrectly with it. And that's a reasonable thing that's going to happen. It's going to happen. Sometimes I do the same thing. I got models that are just really, really good. But sometimes the old man thinks he's better than the average bear. And I'll go out there and I'll engage with it. And I'm like, oh, yeah, I'm wrong. I didn't do that one right. And I either have to close it or I'll just let it have the stop. It's okay. But I'm not throwing that model out and saying, man, I'll never touch that one again because it didn't work in my favor. And I'm not thinking, well, I better get it back real quick, because I know that the market's going to be there tomorrow. I know the opportunities are going to be there tomorrow. I know that the market's delivered on a time-based delivery schedule. So that means since you know what time it is, you know what day of the week it is, you can schedule your next opportunity. It's not a matter of us waiting around to react. And that's what you have to remind yourself. And that's what you do in your journaling. You remind yourself when you have a losing trade, or if you're in drawdown, you tell yourself, I'm so thankful that I don't have to worry about these things running out of opportunity. My model will repeat again. And I have done something that's out of spec today as the operator with this model. And that's normal because I'm learning to get better at doing it. And now I have experience that it costs me a little bit. Just like a college degree, just like you going to work, you got to go to a trade school and you get some kind of a skill or with a certificate or whatever. You had to invest in that to get that new skill set. Well, now you have a new skill set that the market cannot take away from you. You have experience dealing with that criteria, that type of thing, with that mindset you applied at the time when you took the trade. And the worst thing that we can do as traders is to then beat ourselves up and say, well, you did this wrong. You're never going to do it right. You're going to constantly blow the account. You're going to take more losses all the time because you can't control yourself. That's the worst thing to do. You have to tell yourself that it's normal for you to take a loss. It's normal for you to feel uncomfortable with the loss, but then you come in and you counsel yourself because no one else is going to do it for you. You have to remind yourself that this is all part of being a trader. You're going to have lots of losing trades throughout your career. And the faster you warm up to the idea that they're harmless when you control the amount of leverage that's been utilized for that loss.